Hello everyone. Today we are going to see accounting for share capital. First we should know what is the meaning of company. A company is an incorporated association that is an artificial person. It has been created by law and the legal personality distinct and is separate from its members, perpetual succession and a common seal. So its a characteristics also given here, that is the company is an incorporated association and it is an artificial person created by law. It has a separate entity, it has perpetual succession, it has a common seal, that is official signature of the company. Let's see what is public company and private company. A company that has a minimum paid up capital of rupees 1 lakh or such higher paid up capital as may be prescribed by articles, that is called as private company, except for one person company limits the number of members to 200 and it should have at least two directors. It prohibits any invitation to the public to subscribe for any securities of the company, and the name will be ending with the private limited company. Yes, so these are the information related to private company. And public company point of view, it is not a private company. It has a minimum paid up capital of rupees 5 lakhs or such higher paid up capital as the case may be prescribed in the memorandum. And there is no restriction on the maximum number of members here. However, the maximum number of members depends upon the number of shares allotted. And public company, it may be a company limited by shares or limited by guarantee or an unlimited company. In case a public company is a limited company, then it must add the word limited at the end of its name. And this public company should have at least 7 members and 3 directors. Let's see what is share capital. It means the capital raised by the issue of share, the amount invested by the shareholders towards the face value of shares are collectively known as share capital. And we shall see what is authorized capital. Authorized capital, it's nothing but the capital which is authorized by the memorandum of association to be the maximum amount of share capital of the company, which is called authorized capital. Coming to what is issued capital. It refers to nominal value of that part of authorized capital which the company issue from time to time for subscription. Then coming to subscribed capital. It refers to the capital which has been subscribed by the members of the company, and we shall see what is unissued capital. And it refers to that portion of the that is authorized capital which has not yet been issued. Let's see what is uncalled capital. It refers to the portion of the issued capital which has not yet been called up by the company. Then what is reserve capital? It refers to the portion of uncalled share capital which shall not be capable of being called up except in the event and for the purpose of the company being owned up. Then we shall see what is preference shares. A right to receive the dividend before equity shares, and at the time of winding up of the company, these preference shareholders are having preferential right in the payment of repayment of the capital also. So these are all the special characteristics of this preference shares, and these preference shares have different types. First one is cumulative preference share. It means here if the in case if no dividend is declared in any particular year, the arrear of dividend shall be paid in the year in which dividend is declared. So the arrear of dividend on cumulative preference shares are shown in the balance sheet as commitment. Coming to non-cumulative preference shares, in which the arrear of dividend do not accumulate as per the express provision in the articles. And next one is participating preference shares. In addition to two basic preferential rights, it also carries one or more of the some rights like right to participate in the surplus profit left after paying dividend to equity shareholders at a stipulated rate, and a right to participate in the surplus asset left after the repayment of the capital to equity shareholders on the winding off of the company. Then coming to non-participating shares, preference shares. These shares, a preference shares is always deemed to be a non-participating preference shares which is not participating share. So it was called as non-participating preference share. Coming to convertible preference share, this is the share in which it confers on its holder a right of conversion into equity shares. Coming to non-convertible preference, in which does not confer on its holder a right of conversion into equity unless otherwise stated, a preference share is always deemed to be a non-convertible one. Coming to redeemable preference shares, it means the shares which is redeemable in accordance with the provisions of section 55. Now, no company limited by shares can issue any preference shares which is irredeemable. Before going into the important points in case of an issue of shares to the public, we should know what is equity share. So, equity share is a share which is not a preference share. So, according to section 43 subsection A, equity share capital may be with voting rights or with differential right as to voting, dividend or otherwise in accordance with such rules and subject to such condition as may be prescribed. So, we shall move on to this particular important points in case of an issue of shares to the public. First one is prospectus. When a public company intends to raise capital by issuing its shares to the public, it invites the public to make an offer to buy its shares through the document called prospectus. And next one is compulsory listing. Every company intends to offer shares or debentures to the public for subscription by the issue of prospectus. They should, that is, before such issue, make an application to at least one recognized stock exchange for permission for the shares or debentures intending to be so offered to deal in stock exchange. The name of such stock exchanges must be stated in the prospectus. Then we should know what is application in this. An application for shares is an offer to take shares made by an applicant. The amount which the applicant is required to pay with application is called application money, and minimum application money per share. That means on each share must be at least 5% of the nominal amount of share should be collected, and application money to be deposited in the scheduled bank. All money received in the form of application, it should be deposited and it should be in scheduled bank until the certificate to commence the business is obtained, where such certificate has already been obtained until the full amount of minimum subscription has been received by the company. Hope you all understand today's topic. We shall see the remaining topics in the next video. Kindly subscribe my channel. Thank you.